Hello, my name is Timothy Lee Rogers Sr., and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. Inside this powerful course designed to transform your financial future, I've meticulously condensed over 1,000 of my public YouTube videos into 40 highly efficient lessons that span just 2.5 hours. This course is strategically designed into 4 phases to help guide your learning in the most logical and effective way possible. Phase 1 lays the groundwork, covering essential financial literacy like budgeting, banking, and taxes. In phase 2, you'll move beyond the basics, learning about brokerage accounts, figuring out how much you need for your own individual retirement. You learn about how to do fundamental research on companies, and you'll also learn how to conduct technical analysis by looking at stock charts. Phase 3 empowers you to build a robust portfolio and leverage your capital using advanced techniques like options and futures, and it also teaches you the importance of backtesting your strategies. Finally, phase 4 takes a deep dive into the advanced ICT concepts, giving you a professional edge. Each lesson includes a short quiz to help solidify your understanding. By the end of this journey, you'll have the confidence and tool that you need to make intelligent investing decisions, manage your money without fear or ambiguity. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here. Good evening, good evening, good evening. Thank you very much. Thank you very much. How y'all doing, man? Good evening, everybody. What's up? What's up? What's up? I'm the man. Ooh, ooh, ooh. What's going on, man? How y'all doing? If this is your first time tuning into Tim's Tidbits, please allow me to say welcome. But if it's not your first time tuning into Tim's Tidbits, I still want to say welcome. But I want to give you a nice hearty thank you for always tuning into Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That should mean Big Spot if you don't hablo español. And you're in tune to another episode of the NQ Price Action Recap. Yeah, man. That boy AI McGee these days, boy, you can't tell me Natron when it comes to with the AI, man. I'm going crazy with the AI. Who we got up in here? Oh, man. Man, I take one day off and hey, the crowd is empty. Talk to myself. Ain't nobody. We got light skinned Deborah in here. Y'all give it up for light skinned Deborah. We got what that is, Steve up in here. I knew it was light skinned Deborah because I could see the thing before I even pulled it up. Y'all give it up for Steve up in here, man. We got Hitler and shit over there in YouTube land. Give it up for Hitler and shit on YouTube land. We got Kim over there in YouTube land. Got Shatter. What's going on, Shatter? We got Honey. Drop one of Clue's bonds for Honey, man. Uh-oh. Come here. Why did you change? Drop one of Clue's bonds for Honey, man. I'm on live. On live. Yeah, man. Shout out Honey, man. Drop one of Clue's bonds for Honey. Drop one of Clue's bonds for Honey grandson. Honey grandson, the man of the hour. Hey, man. I ain't gonna hold y'all up. How y'all been, man? I ain't seen y'all since. When last time I seen y'all? Did I do a weekend chart prep this week? He'll learn to share. Note taker. When last time I seen y'all? Deborah, when last time I seen y'all? Did I do a weekend chart prep this week? I know I didn't do a price action recap yesterday. I didn't do a price action recap yesterday. I don't
You
know.
did one Sunday evening, I believe.
Chart prep. Yeah, I did a weekend chart prep Sunday. That's what it was. Sunday afternoon. Sunday afternoon, I did a weekend chart prep. Let me get my headphones on here so I can turn my speakers off. Yeah, I did a weekend chart prep Sunday afternoon because I remember I did it early and I kept saying the evening. But man, how y'all Monday and Tuesday go, man? How y'all Monday and Tuesday go? Y'all Monday and Tuesday went all right? Y'all Monday, Tuesday went all right. Y'all, hey, gang. For those that was there for the pre-market analysis on Monday, right? Y'all see how Phil was holding the price in a range, sending people to the reset line. But them levels that we identified was leveling. Y'all excuse me, man. My OCD acting up right now. Cause I got, y'all know my desk. When I redid my desk white. It's been a white desk for a while, but I redid it and I got a new white desk that I made. I didn't buy a desk. I actually just bought a bunch of wood from Home Depot and made a desk, mounted it to my wall because you know my daddy was a carpenter, so I can do stuff like this right here. And I got a white desk, and I don't know what it is about Columbus, Georgia, man, but there's a lot of dust in Columbus, Georgia. There's a lot of pollen and a lot of dust, right? So I'm constantly dusting in my house, like on the ceiling fan. I'm constantly getting that little hand thing and rubbing it around the ceiling fan, constantly dusting off my cameras and my TVs. It's like it's so much dust and pollen in Columbus, Georgia, right? So y'all excuse me while my OCD kick in. I'm dusting all. It be like, it get on my nerve. Now just dust all of this off. By the end of this live stream, I'm probably gonna be done picked up that and dust some more. Right? What is dust? What does dust come from? I'm on one now. If y'all ain't used to how I do, and this kind of stuff get on y'all nerve, the door ain't moved. I moved my desk to a different room, but the door ain't moved. It's still over there. It is still over there. All right. Let me go ask my homeboy, my homegirl. I'm sorry, Gemini. Go ask my homegirl, Gemini. Do a temporary chat. Where does dust in the house come from, and why is there so much of it in Columbus, Georgia? It's coming frustration. Speak, Gemini. On my phone, I can make her talk. I can't make her talk on the computer. Man. On my phone, all I gotta do is click a little. On my phone, all I do is click a little play button over here, and she'll read it.
It's a common frustration.
Hey, who are you?
Dusting on Saturday, and by Tuesday, there's already.
Who are you? My Gemini is a female. Who is this guy that was just talking? Who is this guy that was just... My Gemini on my phone is a female. Who in the world is this guy? Did somebody change something on my... Let me go in here. Where does the dust in the house come from, and why is there so much in Columbus, Georgia?
Dust is a universal household mystery, but
See?
living in Columbus, Georgia,
female.
actually adds a few local ingredients to the mix that make it more persistent. Here is the breakdown of what that dust is made of, and why it seems so much worse in your area. 1. Where does the dust come from? Contrary to the popular myth that dust is 90% dead skin, it is actually a complex cocktail
Get
of
outta here,
indoor
you
and
guy.
outdoor sources. Outdoor infiltrators, 60%. The majority of household dust is actually soil, sand, and particulate matter tracked in on shoes or blown through windows and doors. The human and pet element, you and your pets do contribute skin cells and hair, dander. While not the only source, an average person sheds enough skin daily to feed millions of dust mites. Fabric fibers. Microscopic lint from carpets, curtains, bedding, and clothing breaks off and floats until it finds a surface to land on. Microorganisms. This includes dust mites, which live off the skin cells, mold spores, and pollen. 2. Why is there so much in Columbus, Georgia? Columbus has a few environmental factors that make it a dust magnet, especially this time of year. The Georgia red clay factor. Columbus sits right on the fall line, where the Piedmont Plateau meets the coastal plain. This region is famous for its ultisol, better known as Georgia red clay. The texture. When red clay dries out, it becomes an extremely fine powdery silt. The stickiness. Because it's rich in iron oxide, it's heavy and stains easily. When it's dry, the wind picks up these fine particles easily. When it's tracked in on shoes, it binds to carpet fibers more aggressively than standard sand or dirt. Pollen capital. We are currently in late April, which is peak yellow coating season in Georgia. Pollen as dust. In Columbus, the high concentration of pine, oak, and pecan trees creates a massive volume of yellow dust. Even if you keep your windows closed, these microscopic grains enter through HVAC systems and settle on every surface, significantly increasing the dust volume in your home. Recent regional air quality. Interestingly, there have been air quality alerts in Georgia as recently as last week.
That's enough. Appreciate it, Gemini. See, my Gemini is a female. I don't know who that dude was talking just now on Al Gore's internet. I don't know who that was. I'm like, hey, who are you? Get off get out of here. But everything she was just saying, that the fibers and stuff off the curtains, and like I got hardwood out there, but back here in the room is carpet. Then I got this green screen back here and pollen. She said even if you keep your windows closed, it's still coming through your HVAC system. Pollen, mammy. I'm telling you, if I go outside right now, it's been raining. It's been raining all day. I bet if I go outside, my Suburban covered with pollen right now. Man, Columbus, Georgia, a different place, man. Now that we've separated the wheat from the tail, y'all give it up for yourself for sticking through that. Y'all already know how I do. Y'all know how I do. Y'all know once I get on something, I can't. I know you getting ready to Google it. Y'all know I can't let it go. Y'all know I can't let it go. All right. Between today and yesterday, did price do anything that caught somebody off guard? Did price do anything that caught you off guard between today and yesterday? Since we didn't talk about price action yesterday, we didn't do a price action recap, right? Not a bee in your bunny. I see you got a bee in your bunny. Not a bee in your bunny. He'll learn that she out here sounding just as country as light-skinned Deborah. You got a bee in your bunny. Y'all turn your attention on over there to the Charty Tarts over here. And let's look at what we got a going zone, right? When we zoom out, y'all already know we looking at the front month. So price over here look real splatty, right? And we already know that we have traded up beyond our buy side liquidity. That's our highest high that we were watching before making all-time new highs. We've traded above such area, and we also had our Fibonacci tool set in place, talking about our projections, right? And I'm not recording any of this right now. And so here, and probably won't be a gem from the live stream for this right here. So looking at our high that we was watching before, making all-time highs, looking at our projection using the magical Fibonacci tool based off our manipulation leg, right? We see here that we are up here at 1 standard deviation of our manipulation leg here. That manipulation leg dropped down into our long-term sell side liquidity target that we had back then, right? This was back during what, March sometime. We was watching to see if price would draw down into that low right there. I believe it was back during, like here, this started. Yeah, so March started over here. So we was consolidating here between February and March. Then we started to break down, and that right there was our downside target for liquidity, right? Y'all shout out Lump pulling up in the building. What's going on, Lump? Y'all give it up for Lump pulling up in the building.
What's up? I'm just chilling.
If y'all clap it up for Lump, that might motivate him to get over there to the post office. You know what I'm saying?
I went yesterday. They wouldn't accept cash.
Okay. All right. So we came in there. Then we see we've come to 1 standard deviation of that manipulation leg, right? And now that we've hit that 1 standard deviation, right, we're up here at a little had a little bit pulled back into that order block right there, but we're right up there around that 1 standard deviation area right there based off of our projections, right? So looking at that from April 13th, right? From April 13th through today, right? It's been nothing can stop me. I'm all the way up. We had made any effort to retrace from April 13th through today. Today was the first day that we had this much of a pullback, but we still haven't had a true retracement into a discount yet since April 13th, right? When we reached our sell side liquidity target, we expanded up, pulled back down into a discount, into a balanced price range, went here, consolidated, right? Then we left that area, right? Once we left that area there, right? Now all of this down here is a balanced price range there. So we trade down into our imbalance, leaving this balanced price range. And once we did that, that was April 13th when we traded down into that imbalance, leaving this balanced price range. And then we straight up. As you see, no effort to retrace at all. No retracements at all. So right now, based off of our projection, we've reached 1 full standard deviation. And at this moment, from that high on April 27th down to the low of April 13th, that right there is our current dealing range on the daily time frame, right? Tim, why do you say that's our current dealing range? Because from this March 31st low all the way up to that April 27th high, that's our entire dealing range, right? That's our entire dealing range right now. And from the April 13th low all the way up to that, April 13th low up to that April 13th high, that's our latest expansion leg on the dealing range. Expansion leg, displacement leg, whatever you want to call it, right? And you're always looking for your trading opportunities within that latest expansion leg of your dealing range, right? That latest expansion leg is your current dealing range where you're making your trading decisions, okay? And right now, this is our current dealing range that we're looking. Black Al Davis, I'm sorry, y'all. I just saw a whole dissertation pop up over there in the chat right there. right? I ain't even read it. I just saw something go. The whole chat just moved like, and it's a whole dissertation over there. Somebody remind me to go read that dissertation in a minute when I finish talking about this right here. So that's our current dealing range on a daily time frame. Outside of just seeing our current dealing range, we're up here in an extreme premium. As you see, we're above the upper quadrant. We're in an extreme premium of our current dealing range, right? In a buy program. That's pretty much all the daily time frame is giving us right now, right? That's all the daily time frame, because it's just been one directional, right? Since April 13th, it's just been one directional, and today is April 28th, and so from the 13th, right, over, that's 12 trading days, 16 calendar days. Right, so we're looking at 12 trading days, 16 calendar days of just pretty much going up. We have a huge buy side imbalance in price right now. Right, that's a throwback term. That's throwback term. We ain't been using that one a lot. Y'all, you know, when you first start trading ICT, you be talking about a buy side imbalance, a sell side imbalance. We be using them terms, but then not everybody just want to talk about the business and the civics. The buy side imbalance, sell side inefficiency. The sell side imbalance, buy side inefficiency. Don't nobody just talk about the buy side imbalance no more. You know what I'm saying? Back in the day, they used to call this a liquidity void, right? Because ICT was trying to explain to them, that's not a liquidity void, man. That's a buy side imbalance. Price just going in one direction. No, it's a liquidity void. So he said, okay, it's a liquidity void. So he was just teaching it as a liquidity void so that people can understand what he was talking about. But this is just a buy side imbalance, right? So what does that mean, Tim? Why are you harping on that? Because we know the algorithm. What's the two things? Light skinned Deborah, I know you in here, and don't act like your mic don't work. Light skinned Deborah, what are the two things that the algorithm always seeks?
And balance and liquidity.
Man, y'all give it up for light skinned Deborah, man. Drop one of Clues bombs for Deborah, man. The algorithm is always seeking balance and liquidity, right? So it's going up here seeking this liquidity that we pointed out. And now that it's up here in this liquidity pool, right? What do we say we have? A buy side imbalance. So at some point, we anticipate price to come back and start offering sell side, right? And so how do you just determine what's inefficient? What's oh, I'm glad you asked that question. We're looking for inefficiency in price. So when we look here, we see that price offered a whole bunch of buy side and sell side delivery in this area right here. And then we left this area. Once we left that area right there, run the green. What did that produce once we left this area? Once we did that, what did that produce right here? What did it produce? Talk to me. What did that produce? Run the acting like, now run to be on here coughing and sneezing and burping and everything. And now when I ask a question, she can't talk. Shout out Kim in the y'all give it up for Kim in the YouTube chat. Come on, clap. A balanced price range, right? So now that we've offered buy side delivery and sell side delivery, and once we leave that area, that makes this a balanced price range, okay? Once price is below a balanced price range and is bullish, we anticipate price to slice through it like it's butter, right? And what do we do from the 13th up until now? Sliced right through that like it was butter, okay? So now this area here, right? Now that's a balanced price range. Okay. So now that price has been going up in one direction, right? We would anticipate it to come back and offer sell side delivery in places that it's lacking sell side delivery, right? So when we come down, we see here, we're being very deliberate about how we're going up, right? So if you look here, right, we offer buy side and sell side here, right? Start to leave this area there, right? Then we left that area there, okay? Then we came back down, right? So we're being very deliberate about how we're offering price in this area right here, right? Very deliberate about how we're offering price in this area here. So we're being very efficient with how we're delivering price there. So now the algorithm, right, if it decides it wants to retrace and attack some level of sell side, right, when we come back down, right, there's not a lot of places that hasn't been offered buy side and sell side. So we could come down and use this balanced price range as support without even digging too deep into it in the sense of a low resistance liquidity run. All right. So in the sense of a low resistance liquidity run, we can come right back to, right, our bullish breaker over here, or we got two bullish breakers there. We got a bullish breaker here and a bullish breaker there, right? So we can come down to any one of these bullish breakers and use them as support because they're on top of this balanced price range right there. And we've been very efficient about the way we've been delivering price in this area right here. So there's not a lot of places where there's not a lot of range of inefficient delivery on this way up, right? Because when we cut through this balanced price range right here, right, you see price got very efficient again as it was tippy-toeing up, right? So there's not a lot of inefficient delivery in this area. Okay, everybody see that? Everybody understand that? Can price still come down into this area? Yes. Is it a good idea for price to still come down into this area? Yes. What, Tim? I thought you just said as price stands right now, we are in what? We said we are in what? An extreme premium, right? We're in extreme premium. So for our latest expansion leg, we're in an extreme premium. And where is the discount? Right here, below that red line right there, below 26,223 and a half. That's a discount for this entire move right here, right? What else does that do? That brings us back to a weekly inefficiency, right? So if we come back, if we jump up to a weekly time frame, right? If we jump up to a weekly time frame and we look at that same range on the weekly time frame, right? Remember the 13th low, right? So on our weekly time frame, if we retrace back down into a discount on our weekly time frame, that brings us right back into our weekly discount PD rate, right? Because remember, these are our trap traders down here at this breakaway gap. Why is that? Right? That's our little V shape when we attacked liquidity and then took off really quick, right? These are our trap traders down here, right? And now that we've left this area, right, we've cut back through the balanced price range. Now we want to see this balanced price range act as support. If we come back down to our weekly PD rate right there, right on top of our balanced price range, right? So the higher time frame has a reason to come down here, right? That's the weekly time frame. It's got a reason to come down there. So we come back to the daily, our daily time frame. What does that do? That brings us back down to a discount of this range right here. Like I said, for a low resistance liquidity run, we could come back to a discount, to our discount PD array, right? And then if we look at our daily time frame right here, right? Remember that breaker we was talking about, right? Remember that breaker? I just saw this right here, by the way. I just saw this as I was talking. I just happened to glance over there, right? Remember that daily breaker we was talking about right here? The second break, we said we had a breaker there and we had a breaker here, right? What do y'all notice right here, right? If I click there, I click right there, right? If we look at that range, let me move the BPR out of the way so y'all can see it, right? Y'all see right here, when we was consolidating here and we took off right there, that's the first BISI that was created when we came up, took out that buy side, and dropped down right there. We got that change of state delivery. So we come back above and close above that right there, right? Now we're anticipating, like, we created a BISI, didn't use it as a BISI right here. Came below it, used it, that looks crazy. Came below it, used it as an inversion fair value gap, right? Came back above it right here, still haven't used it as a reclaimed fair value gap. So now we can anticipate it when we come back down to it again to use it as a reclaimed fair value gap, right? So we got a reclaimed fair value gap lined up right there. We got a bullish suspension block on the weekly lined up right there. So there's reason for price to come down here to a discount to give smart money an opportunity to participate in this very strong buy program that we're having. And one little nugget, right? One little nugget I'm going to drop off here. This reclaimed fair value gap right there. I'm going to make this blue so that it looks different from the suspension block, right? This reclaimed fair value gap right here. Right, since we have a weekly suspension block right here, right, we have to allow for the weekly, the higher time frame to do its job. So if we see price come down to this reclaimed fair value gap, right, and continue through it, right, no woman, no cry, don't panic, because we have a higher time frame PD array resting right there that needs the opportunity to do its job, right? And if we look here, we see we got a fair value gap that's leaving this area right here, right? This is the first one leaving this area. This is the very first one on the takeoff, but this is the first one that's leaving this area that we never used, right? So if price want to just dive deep, right, and come all the way down to that BISI right there, still respecting the consequent encroachment of that higher time frame, no woman, no cry, then what you would look for is, right, once we get back above it again, now you're demanding that price uses this as a reclaim and not slip any lower. You're demanding it there.
Let him cook! I said let him cook!
If y'all missed that little gem I gave right there, rewind and then watch it again. But y'all do me a favor, hit a like for the algorithm and subscribe to the channel if you ain't subscribed. Now, let me go read this dissertation. Rhonda, where you at? Rhonda, why you on there playing like you can't talk? Huh? Where you at, Rhonda? You at Ajima getting your feet did? You getting the full set? Manicure, pedicure, full set? You know, you getting heels worked on? Bunions massage? What you got going on? You can't talk right now? Oh, okay. All right. I feel you. The Blackout Davis. Good evening, Tim. Money management question. Did you or anyone else trade with just 1% of your account when you started out? Blackout Davis. Blackout Davis always popping up, asking me stuff that he already asked me 99 times. I could tell me and Blackout Davis got to be about the same age because we be forgetting stuff. Hey, let me go full screen for this right here. All right? I'm going full screen for this because this is a very, very, very important question. There is no such thing as a one-size-fit-all money management, money management template. There's no such thing. Everybody's risk appetite is different, right? Everybody's risk appetite is different. So it's not wise for people to just give blanket statements when it comes to money management. I look at all the gurus and furus and those alike on Al Gore's internet, and they be like, oh, just risk 1% of your capital. Oh, shoot for 2% returns per month. Oh, shoot. Get out of here. Everybody is different, right? So when it comes to money management, that's a question can't nobody answer for you. Can't nobody answer that for you, because you may be a little bit more risk averse than me, right? Or you may be a little more, you may be a little bit greedier than me. So you want to shoot for bigger targets as targets, right? And the bigger targets may require bigger risk. And then sometimes the bigger targets don't require bigger risk. They just require better setups. You're taking, I ain't gonna say better setups, but you're taking less trades. You're taking less trades because you're holding the trades for longer. You know what I'm saying? And if you're holding them for longer, then you're probably risking more because you're trading off of a higher time frame, right? Or you just getting lucky and getting 8-to-1 trades every day. You know what I'm saying? It's so many things that go. That's when people talk percentages. It's so many things that go into those percentages. Because if I have an account with $250,000 in it, right? I can say, oh, you only need to risk a 1/4% of your account and shoot for 0.5%. That's a lot of money if I got 250,000. That's a whole heap of money. That's a good matter of fact. Let's get my calculator. Me too. August the 6th, I'll be 54. I'll be 54 August the 6th. And I expect my Cash App to be lighting up. Boy, if y'all ever got anything out of my YouTube channel on August the 6th, I expect $, the new TLR, to be off the chain come August the 6th. If my Cash App ain't blowing up on August the 6th, I'm deleting my whole YouTube page. My whole YouTube page, I'm deleting it. Right? So 250,000. Right? That ain't right. That's 25%. 250,000. That's 2%. That's 25%. $650. Yes, that's right. That's right. Yeah, that's it. So a quarter of a percent, right? $625. All right. And shooting for 50%, right? Which would be, what's that? $12.50. Right? $12.50. Right? So you say, oh, you only need to risk a 1/4%. Because I got $250,000. And so if I'm risking 625, that's natron. You see what I'm saying? But I'm only risking 0.25%, right? And then, you know, if I make the 0.5%, I'm making 1250, right? So 1250 on a trade, that's good money. You know what I'm saying? That's good money. But then you get somebody who all they got is $2,500, right? That's $6.25 that they risking. All right. They're risking $6.25. That's natron when it comes to having $2,500. But then you only making $12.50. Can you live off $12.50? You see what I'm saying? Right? You know what I'm saying? So for me to come out here and say, oh man, you just need to risk 0.25% and only shoot. Yes, over time, this is going to benefit you well. But the problem is, we all want to be able to live off of trading right now. We want to be able to live off of trading right now because everybody on the internet, they got us brainwashed that, man, you go out there and you trade for 3 months and you can retire. But they want us to work on our job for 30, 35 years. But you want to retire from trading in 3 months. Right? And how you do that? By over leveraging, risking too much. Right? Now let's look at the flip side of it. Right? Let's look at the flip side of it. If you got an account, let's pretend like we got the amount of money that these prop firms be saying that they give us, right? Now, mind you, this is the size of the prop firm. I'm putting this over here, 50K, right? All right, so we go buy a 50K account, right? And they put in our mind, you got $50,000 worth of funding, right? So then you go in and say, okay, I'm going to risk 1% on every trade. 1%, right? Minus 1%. That's $500. Right? So you're risking $500 per trade. Because you say, hey, I got 50,000. I'm risking $500. Right? Now, let's look at the real deal Holyfield. When you buy a 50K account, right? When you buy a 50K account, your max drawdown is $2,000. That's your max drawdown, right? But they're telling you, you got $50,000 worth of funding. And you be like, oh, I got 50,000. I'm going to risk 1%. I'm going to risk $500 per trade. You only got $2,000. Right? So in reality, right? Him should only be risking $20. In reality, that's the reality right now. If you're going off the percentage model that everybody put out there, right? Are you comfortable? This is the flip side of it. Are you comfortable with risking $500, right, on a 50K account? You might be. But are you comfortable risking $500 when you only got $2,000? I hope you're not. Because guess what? If you risk $500 and all you got is $2,000, all right, 2,000 divided by 500, you can only be wrong 4 times. If you take 4 losses in a row, 1, 2, 3, blows your account. Now, if you got a funded account, you should go into the reset line. Make sure you use my code that I got down there when you go to the reset line. You just go to the reset line and then crank it back up. But if you put your hard-earned $2,000 in an account and you risk 500 every time and you go on a 4-trade losing streak, you just wiped out your $2,000 and you can't reset. All right. So back to the original question, right? About money management. Money management is an individual thing. If you are comfortable risking 1% of your capital, that's you, right? You have to be honest with yourself. Am I willing to risk this amount of money? Because people like to throw percentages out there and make them sound like, oh, you're not risking a lot, right? But if you're not comfortable or risking a lot of money, it don't matter if you got a $2,000 account, a $50,000 account, or a $200,000 account. If you're not comfortable with risking a lot of money, you're not going to be comfortable risking a certain percentage. You're not going to be, it's like you have to determine how much am I comfortable with risking, right? How much am I comfortable with risking and how much growth am I looking for, right? And then you have to find that happy medium. Tim, what do you mean by that? All right, let's look at it, right? If you got, because people like to holler percentages, but at the end of the day, it's all about how many dollars coming in and out of your account. All right. So if you say, matter of fact, everybody on here, type a number in the chat that you feel like you could live comfortably off of as far as monthly income. Type a number in the chat that you feel like you can live. I ain't talking about my dream goals. I'm just talking about a number, monthly income, a realistic monthly income right now that you can just live comfortably off of right now. It can be the amount of money you make now. It can be less than the money you make now. It can be more than the money, but I ain't talking about, oh, I want to make $1 million a month. I want a real number, right? A real number that I can live comfortable off of. Okay. First one I seen pop in was from the Black Al Davis. Right, first one I saw 5,000 from the Black Al Davis, and I saw 4,000 pop in from light skinned Deborah, 5,000 from Kim. Right, so 8,000 from Felicia. Felicia stayed in a mansion somewhere, y'all. Don't mind Felicia, man. Felicia bougie. Right, so 5,000 like the sweet spot. Right, 5,000 the sweet spot. So we gonna say $5,000. Right. That's what we say we can live comfortably off of, right? Now, with $5,000, you got to remember this now. When you're making money, Uncle Sugar want his money. You feel me? Uncle Sugar want his money. So if you saying 5,000 is what I can live comfortably off of, you got to make more than 5,000 because you got to give Uncle Sugar his money. You feel me? All right. So, and when you're, you know what I'm saying, when you're trading, you're making money, they're charging you for capital gains, right? They charging you for capital gains. And if you're, you know what I'm saying, depending on the tax bracket you're going to be falling in, right? It behooves you just to say, okay, I'm looking at the highest tax bracket. That's what I'm telling you, right? Because it don't take much to hit that tax bracket. You feel me? Right? And then if you stay somewhere like the state of Georgia, you got state tax, right? So you might as well go ahead and get ready to get Uncle Sugar somewhere between 27 and 30% of your money. You feel me? So we're gonna round up in this case and say you gonna get Uncle Sugar 30%. All right. So you want to make more so that you can get whatever. So if you get Uncle Sugar 30%, let's just say, let me see. Let me do a quick number and see how good my math is mathing. Right? So let's just say 9,000 minus 30%. My math a little bit too high. 8,200 minus 30%. I'm getting closer. 8,000 minus 30%. 7,800 minus 30%. 7,500 minus 30. Close enough for government work. So we're going with 7,500. All right. So 7,500. That's our number. All right. 7,500 is our number. Right? Because we got to get that 7,500 so we can pay Uncle Sugar and we get our 5,000 to live off of. And then we can let me 7,500 minus 30%. Right? We got $250 that we can put up for a rainy day. You feel me? So we got our 500 living comfortable and 250 so we can, you know what I'm saying, keep that off in the tuck and let's just play money. You feel me? All right. So 7,500 in a month. In the typical month, you know what I'm saying, there's usually like 4 weeks in a typical month. Right? 4 to 5 weeks. So we're going to make it easy math. And we're going to divide that 7,500 by 4. All right? So we're going to look at that 7,500. It's right here. That's what we bring it home. So 7,500 divided by 4. Right? So if everybody agreeing, hey, man, I can live comfortable on 5,000. Right? Now, you see that we need to be clearing roughly 1,900 a week, right? We need to be clearing roughly easy math. We need to be clearing roughly 1,900 a week, right? See, 1,800 times 4 give us 7,200. Let me see. Right? 18, and that'll still give us 5,000. So we need to be clearing roughly 1,800 a week, right? If we clear 1,800 a week, we can clear 5,000. I just did the math real quick, right? 1,800 times 4, that's 7,200 minus 30%. That's 5,000, right? So we need to be clearing at least 1,800 a week, right? At least 1,800 a week to live off 500. So if we need to make at least 800 a week, right? We need to make at least 1,800 a week. Now, you can look at it as a weekly thing, right? Just so that you ain't trying to make yourself trade every day. Or you can look at it as a daily thing, right? So you know how much you need to make in a week. So you say, I trade every day. So divide that by 5. I need to make $360 a day, right? I only trade 3 days a week. Divide that by 3. I need to make $600 a day because I only trade. So this is somebody trading every day, and this is somebody trading 3 times a week. right? So now you know your numbers that you got to make on a daily basis, right? So now, because people be like, oh, it's about the percentage. Everybody got in their mind a number that they want. Screw them percentages. Everybody got a number that they want. You feel me? Right? Them percentages just work when you're trying to brag to somebody and say, oh, I could get you a 7% return in a month. Everybody got a number in their head. Because you know what they think about when they say 7%? Oh, man, 7%, that's $7,000. They don't think about the percentage. They think about how much money that is. You feel me? All right? So now, you say I need to make $360 a day. Okay? I need to make $360 a day. So if I need to make $360 a day and I'm trading the MES, or the MNQ, I'm sorry, y'all. I'm trading the MNQ, right? That means, right, 360 divided by 2, that's 180 points, right? That's 180 points if I'm trading one contract, right? So if I'm trading one contract, I need to clear 180 points to the positive. Not saying I ain't never got to lose, but I got to clear 180 points to the positive every day of the week, right? I got to clear 180 points every day of the week if I'm trading one contract, right? If I'm a 2 contract trader, I got to clear 60 points. No, let me see. 360. Yeah, 360 divided by 4. 90. I got to clear 90 points if I'm a 2 contract trader on the MNQ. I got to clear 90 points a day. I got to be in the green 90 points. Right? So if you're looking at trying to get it in one trade, right? If you're looking at trying to get that amount, if you're trying to get that 360 in one trade, right? You need 180 points, right? So with a 180 point trade, is it doable? Yeah, it's doable. You know what I'm saying? Yes, it's doable. But how frequent are they coming, right? And what time frame are you going to have to use to get a 180 point trade, right? So let's see what a 180 point trade looks like. We're just going to get a long position here, and we're going to click right there. And yep. Let's come down here. Yep. Yep, still going. Yep, still going. All right. So all right. This is a 2-to-1. This is what a 180 point trade looks like, right? With a 2-to-1, with a 2-to-1 risk to reward, right? For that to have hit there, right? So for that to have hit there, right? Okay. Boom, right there. So that's a 180 point trade right there. So just based off this, for that to have hit, right, you would have had to been entering here on this 1234 SIBI right here as an inversion fair value gap there, right? You would have got picked up there, right? And this is just a basic 2-to-1 risk to reward, right? And then that wouldn't have hit until today at 6:03 p.m. right? 6:03 p.m. So that's Yes, that would have been, that's that one, that would have been, it would have went into the next trading day, right? It would have went into the next trading day. You would have had to hold it over the break, risk holding it over the break, but that would have gave you your $360 in that day, right? That would have gave you your $360 in that day. That's the amount that you're looking to get in that day, right? You would have had to hold it over. So then the next day you would have been looking for, now how likely is it to get that amount of a trade? You got to think about that. Is that realistic to hit your target that you're looking for the amount of money that you can live comfortably off of, right? Trading that, right? Then you say, okay, that's a really big stop loss, right? That's a really big stop loss. That's a really big profit target, right? Even though it's just a 2-to-1 risk to reward, that's a huge stop loss, right? And risking 180, risking $180 per trade, right? $180 divided by 1%. Right? So if you're going by a percentage thing, right? If you're going by risking 1%, you would need an account size of $18,000 to be risking 1% to have this right here in mind, risking $180 to make 360. That will be an account size of $18,000 if we're looking at the percent gain. Okay, if you say I'm okay with risking, you know what I'm saying, $180, right? And then now you can go in and tweak it based off of, instead of a static 2-to-1 trade, now you can go in and start to tweak your entry and exit based off of price, right? And if you do it based off of price, okay, let's actually get on the MNQ so that we can make this easy. MNQ M2026. All right, we're gonna actually get on the MNQ to make this easy. Come to that same place. What time's that? 12. Yep, that's it right there. All right, so we're gonna come over here to a long position, right? And we're gonna say that our risk is 1%. Our account size, we already said it was 18,000. Right, our account size was 18 because we already did the math on it. All right, and okay, so now we're doing it based off of what's the name. So here's our gap that we're coming into. So for our mandatory stop is the low of the third candle because we're using it as a bullish gap, right? So right here we can see, I don't know if y'all can see it, it's saying that we can put on 3 micros. It says 3.6 micros, right? We're not trying to over leverage, so we're just going with the 3, right? We're going with the 3, okay? And if we're looking here, all right, so right there we're going to 3, and then we're going to come here and we're going to go up 1800. $17. Amount MNQ. Amount 17. That's supposed to be giving me the dollar amount. Hold on. It's giving me the amount there, but it's not giving me the right amount. Y'all hold on, let me do some math real quick to make sure it's giving me the right thing. All right. 3 times 3.636 times 2 equals 7 times 24.75. Right, yeah, so 180 right there. Times 2. Okay. All right. I don't know why it's giving me that weird number right there. Right? I was thinking it was gonna give me. Oh, I see what it don't have a decimal in there. There's no decimal in there. It says 178.20. That's $178.20. And then that say 183.60. That's no, that's not right. That's not, forget what I said. I don't know what that is. I don't know why it's doing that right there. I don't know why. I don't know what that number is right there on there. I was trying to use the thing so to get, I know it gives you the right number on that for the quantity, but I'm not seeing what it's. You see, that's 360 right there. I don't know what that number is over there. That 18, I don't know what that is. Right? I don't know what that is. So, now, with 3, right, doing it based off of the price. Now, I digress. I'm back now, right? Doing it based off of the price structure, doing it based off the price structure. Now you're managing your stop based off of how IC teaches you to trade the concepts, trading on this inversion fair value gap. Your mandatory stop is here. Your safe stop is there. Y'all can't see that wick. All right. Your safe stop is here, right? And then your mandatory stop is at this wick right here. Okay. Right. So that's your mandatory stop. That's your safe stop based off that PD array right there. And the tool here, right, based off of, we're going off percentages here. The tool, it shows you if I'm risking 1% on an $18,000 account, right, this is how much I can make my daily goal in this trade right here, right? I can make my daily goal. This is all I need for my daily goal right there, right? Matter of fact, targeting that high is beyond my daily goal, right? So if I target that high right there, right? No, a little bit above that high, that's my daily goal, all right? But that's with an $18,000 account, right? So somebody give me a number that they know they comfortable with putting into a brokerage account to trade with. What's a number? 2,000, 1,500, 3,000, 5,000. What's a comfortable number that somebody comfortable with just putting into a brokerage account to trade with? 2,500. That's the first one I see pop in. 2,500 is a comfortable number. All right, so we're gonna change this to 2,500. All right, now 2,500. If we stay with that same 1%, right? If we stay with that same 1% on 2,500, right? So risking 1% with 2,500, we can't even take this trade right here. We can't take this trade with the mandatory stop, right? So we can't take it off of that. So then we say, okay, we can't take it off of this right here. Let's drop it down, see if we can take it off consequent encroachment. We come to consequent encroachment. We still can't take that trade based off consequent encroachment. So we can't take it off of this. Okay, we see we got a BISI over here. Right, let's come over here, see if we can take it off the BISI. Right, can't take the trade off the BISI. All right, drop it down to consequent encroachment. Right, can't take it off consequent encroachment either. Right, still can't get one contract. That's for 1%. Right, come down to the order block. Right, so at the order block, can't take it off the order block. Right, let's go to the lower the order block. All right, so at the lower the order, at the close of the order block, we can take one. Right, called mean threshold is here. We don't want to see mean threshold violated. Right, mean threshold is a highly aggressive stop placement. Right, the close of the order block, we can take one contract. The low of the order block, we can't take it. Consequent encroachment of the wick, we can take one. Right, so at the low, we can take one. Consequent encroachment of the wick, we can take one. Right, wherever you want to place your stop in between this range right here. Now they're saying we can take it. Right, is that reasonable? Yes, that's reasonable, because once we come here and we show that we're respecting the you look at the bodies here, we're respecting the inversion fair value gap and the bullish fair value gap here. Right, buying the order block there. There's nothing wrong with buying the order block and trusting that mean threshold should support price, which can do the damage. So you're putting it below the close or even down there at consequent encroachment of the wick. So that's a realistic stop placement. All right. So with the realistic stop placement, right, we're risking 1%. All right. So we're going to look at 1.22 times 2, because that's just one contract, and right there where we got it, that's 10.25, right? But we can only do one contract, so we're going to do 2 times 10.25. Right, so that's $20.50. All right, so $20.50 to try to get that 360 in one shot. You need 80 points. Right, so try to get that 360 in one shot. You need 80 points. All right, here we go right there. That's 80 points. Wait, let me make my math ain't mathing. 360 divided by 2, 180 points. You need 100. We did that already. We need 180 points. Like my math ain't mathing there. We did that already. Right? So we already know. Right? We already know that just in this one day, actually hit in that one day, right? So it actually hit in that one day, right there. Let's look at that. That high right there. Go slightly above that high. Right there. All right. So we can see it actually hit in that one day right there by 307. But again, it goes back to how likely are we to get these type of trades, right, in one day, right? 180. So with an account size of $2,500, right, you can go in and do it based off the percentage model, right? Do it based off the percentage model and find trades that will, like I say, you're going to end up trading less because it's going to be larger trades you're looking to hold, right? But with very small risk, you're going to have to go into the deep sub 1 minute sometime charts to find trades that you can actually take, right? And we see they will show up. So it is doable based off of the amount of money you want to live off of, but doing it in one trade, that's the thing that might get you. So then you say, okay, since I need 180 points, right? Since I need 180 points, I'm going to divide that 180 by 3 and say, okay, I just need to find 360 trades. See, I need to be up 360 point trades by the end of the day, right? And so when you go back and look at what does a 60 point trade look like, right? This right here is a 60 point trade right there, right? So you say, can I carve out 360 point trades a day, right? Can I carve out 360 point trades a day, trading with one micro on the micro Nasdaq, right? And if I could carve out 360 point trades based off of $2,500, right? I'm not going to be risking more than 1% on a trade, but I need 5-to-1 trades, 5-to-1 risk to what trade. Cause this trade right here, this is a 5.85-to-1 trade right here, right? Almost like a 6-to-1, right? I need 6-to-1 trades every time I trade to make this amount of money realistically, right? So when it comes to money management and all of that, it's a larger scope to think about besides, oh, only go risk this amount, because we're doing this for a living, right? We're doing this for a living. And yes, people who preach percentages to their customers, they're doing it for a living, but they're not doing it for the same living we're doing it for. We're doing it for the living to pay the light bills. We're doing it for the living to pay for the sustenance and the liquid for our bodies. We're doing it to pay mortgages and rents. So we need a specific amount to be coming in, not a specific percentage to be coming in. So it's a lot of stuff we got to think about when it comes to how much money am I going to risk, right? You got to think about how much money I need to survive. Once I know how much money I need to survive, now I need to determine what is it going to take to get that money. Now that I see, oh, if I start out with $2,500 and I'm trading the MNQ, this is a rough estimate of what it takes to make enough money to be able to clear $5,000 a month right here. If I'm only willing to risk no more than 1% of my account, right? Hopefully y'all found value in that right there, man. Now,
the lesson that I found in this is that basically you got to build up to where you can risk more. So even though that may be the goal, that's not what you may start doing.
Yep.
That's basically what you're telling us.
Yep. Exactly. Like I say, when you start out,
So $100 a day it is. $100 a day.
when you start out, you know, because you know what it is? It's about scaling. It's about scaling. So what you want to do, you want to start out small and then learn to scale. And what's going to help you scale is the percent on your account size. So because when you're starting out small, you're starting out risking 1%, right? You're starting out risking 1%. But then as your account starts growing, right, that 1% is growing. Right. And since that 1% is growing, now you're getting to the point where if, right. I grabbed the wrong thing. you're getting to the point where if, right, this, right, we're saying that we're just going to trade, like, just going to put this here, right? We're saying that this right here, this stop loss right here is 1% based off of your account, right? Just that's 1%. But then when your account starts growing, right, this size right here, right, that's going to be more than 1%. Right, let's just say that's 2% now. You've grown it. So this size stop right here is 2%. So since that's 2%, right, what you can do, right, when you reduce this down to there, right, now that's now here, right, just say, okay, now that size there is, well, we'll just say this size right here is 1%, right? Your account done grew and that size is 1%. But you realize you don't need a stop that big, right? All you need is a stop this big, right? So you can come here and now instead of trading one contract, now you're trading two. So it's like you realize, okay, I don't need that big of a stop based off of my strategy. Right? I only need that big of a stop. So now I'm trading two contracts now. So now I'm giving myself the ability to take profit and leave runners, right? To start to grow the account through scale, because I'm scaling up my size quantity wise. I'm not scaling up my size risk wise. I'm scaling up my size quantity wise. And that's going to give me the ability to start to take, you know what I'm saying, take profits at my reasonable target and leave runners to see what else can I get. And that's going to start to make my account grow even more number wise, right? So you're scaling through the quantity size, right? And then once your accounts gets bigger and bigger and bigger, right? Now you're saying, okay, I don't want to risk 1% no more, right? I only want to risk 0.5%, because now 0.5% is making me more than what I really need. You know what I'm saying? And then as they grow even more, you be like, man, I'm not even risking 0.5% anymore. I'm only risking 0.25%, because risking 0.25% is yielding me more than I need. And now you're to the point where losing don't even matter to you, because you're risking such a small amount, but your returns are yielding you more than what you need to survive. You find yourself risking less and less and less and less. You find yourself, you might trade twice a week, because twice a week is yielding you the amount of money that you want to live off of. You see what I'm saying? So that's why I say, like, risk management is an individual thing, and it's all about how much money do you need to survive. And you know, you start out small and build the habits, and then start to scale after that. Shoot for realistic goals, right? Trust me. It's plenty of money out there to be made. It come real fast, and boy, it will turn you into a green-eyed devil.
Question for you.
Yeah.
So, all right, let's just, like you saying, building, and you decide, okay, let's go for $100 a day.
Mm-hmm.
I'm a paper trade it myself just to see, but what do you think? Thoughts on that is just going to, like you said, the 30-second and just hammering out 100 a day on that. If you did it that way, obviously we looking for the clues and everything that leaves, but if you do it that way, do you have to rely so much on a higher time frame chart if you just trying to get in there and get that 100 a day and grow your account?
You always want to rely on the higher time frame, but the higher time frame is just gonna give you an overall bias. If you're trading on a 30-second chart, you're trading the here and now, You're trading like the
Right.
here and now, right now. So you looking at the let's look at our charts, right? So you're looking at, right? We're going to look at we're just going to look at today, for example, right? We're going to use today as our example. Let's chop off this other stuff here, right? And then we're just going to look at our New York time frame. Okay, so we're just going to come in here with the idea that we've reached that 1.5, and we see that we're right now as we come into trading, we see, oh, we kind of struggling with this wick. So we're thinking, okay, we may pull back into this daily fair value gap. That's the mindset that we're going into this with, based off of what we've seen happening overnight. All right. So we're going to drop down into like a 60-minute time frame real quick. Right. And this is our trading day for today. Is this today? Yes. Let's go back up real quick. Daily chart. Yes. Okay. Yeah. Put a line here so I can know this is when this day started. That's our fair value gap, 60-minute. Yes. So this is our day today. Okay. So coming in tonight, we see, and put that wick on there. Y'all be like, Tim, you be going through all this just to give an example, because everything just ain't that easy. All right. So, and that didn't transpose down. All right, so we come in at New York, what's the name? And we say, hey, we're respecting consequent encroachment of the wick, right? We're selling down there, and we see, right, now we're below the daily fair value gap. We've closed below the daily fair value gap here on this 60-minute time frame, right? So we're like, okay, we was anticipating a deeper retracement coming into the New York pre-market. We can see that we have traded down below there. So we got sell side liquidity down here, right? We say we got sell side liquidity down there, right? We also have this, right? We got an inversion fair value gap here, right? We got an inversion fair value gap. They're looking at stuff that can be possible support. Is that I don't know if it's a space there. No space there. No space there. All right, so we got an inversion fair value gap. We got liquidity there, and then we got this first BISI as we take off right there. All right, but we got the inversion fair value gap marked out. All right, so those are areas of support from the 60-minute. All right, then we go in here, find our 930 open. This is our 930 open right here. So when we go into our 930 open, right, coming into our 930 open, we see we traded down into our inversion fair value gap, kissed it, right? And then we traded back up, and we have, this is our first SIBI right here. So since we're in a sell program, right, we're in a sell program here, right? We got efficient delivery, respecting this high time frame PD array, leaving this area, right? We got a balanced price range right there, right? We see our balanced price range, right? Efficient delivery there, leave, we trade back up into that fair value gap, and we kind of consolidate there and displace down again. Okay, so now from this high down there to that low right there, that's our range, right? We leaving that the area that's our range. This is our premium PD array right there. That's the first SIBI that was created coming down, right? So that's our premium PD array, right, that we will be looking to take a sell off of, right? Our first imbalance there. Now we're going to chop some more of this off because I'm going to drop down into our time frame. All right, so come here when price comes back up. This is the candle here when price goes up into there. So we're looking at everything to the right of this candle there, right? So we drop down to our 30-second time frame. Okay, we'll talk about 30-second time frame. All right, so everything to the right of here, that's when we trade up into our PD array, right? We trade up into our PD array there. All right, so looking at our 30-second time frame here, right? Now, remember, we got several ways we can trade. We thinking the overall time frame is bearish, right? We anticipating price to come back up into this right here, because down here, right, we've come down, we've kissed our discount PD array, right? And now we're anticipating price of coming back to a premium of our dealing range, right? So when 930 opens, we immediately drop down and take out all of the sell side. All right. So if we are bearish overall and we immediately drop down and take out the sell side, right, we're looking for this to turn into a wig snatcher. So since we're looking for this to turn to a wig snatcher, we can look for opportunities to trade back into a premium based off this 30-second, right? Here's our PD array that we're anticipating price going into in the premium, because this is where we want to look for reasons to sell, right? So as we come down and take out this liquidity, right, when we take back off here, right, you see we close above consequent encroachment of this SIBI, right, and we also close above this BISI right here. So we come down right there. Don't use it as a BISI, right, because we don't touch it, right? Immediately close below it, right? Come back up. So we don't use it as an inversion either, right? We didn't use it as a BISI, which is its first use. We don't use it as an inversion after closing below it. And now we close back above it. So now what are we doing? We're looking for it, see if we're using it as that first use. Because remember, let's talk about when we trading through these PD arrays, they're not going stale. We're looking to see if we're using them, right? We never used it. So now we close back above. So if you're too afraid to take this based off of that reclaimed BISI and this BISI, right? Because we closed above consequent encroachment of the SIBI, right? We close back above the BISI. So if you're scared to use that reclaim or this BISI to go, now we come up here, get our breaking market structure, get our change in the state delivery. Then we trade back down into the BISI. We trade down into it here before we get the breaking structure. We trade down into it there after we get the breaking structure. And then we trade up into there, right? So we can look at some of these. If you were not afraid to take this here, boop, we taking it off of this. We actually taking it off of this here, right? But it's pretty much the same, right? So now we're looking at, right? We got, that's the swing low for the fair value gap that we're looking at. Since we're trading into this right here, we say, okay, we're just going to go with the low there, right? Because we're trading inside of this BISI, but we're doing it off of this, right? So then we come here and back up here to consequent encroachment of that fair value gap right there is 86 points, right? So based off, and that's 80 points there, right? So based off that, right, you can get, boom, 80 points right there based off of the 30-second chart going against the grain, right? If you take it there. But if you don't want to take it there and you go here with the confirmation entry, right? 80 points would be just above that right there. And you see that that would have been hit if you were just going for the 80 points. But if you was going for something more realistic, like saying, hey, I'm just going to shoot for consequent encroachment, right? That would have gave you like 57, 58 points, right? And then now I still need to find, you know, however many more points left on the day. And that's trading against the grain, right? But if you don't want to trade against the grain of the higher time frame, because you doing it based off what the higher time frame is doing, I mean, you got the idea of what the higher time frame is doing. You're saying, okay, I'm not going to trade against the higher time frame since I know that it's bearish. I'm just going to trade with it, right? So then you would just be looking for trading opportunities once it, you know what I'm saying, gave you, we came up here, we got the we swept the liquidity at our anticipatory reactionary point breakdown, got the break-in market structure, right? And we come back to our first gap there, right? And here, this right here, the first candle, the low is lower than I mean the high is lower than the actual SIBI. So for me, I would be looking at, you know what I'm saying, either that swing high or that, I'll be looking at that swing high more than likely, right? Because this swing high right here, it's inside of a fair value gap, right at the high of that. So I'm like, hey, the algorithm might be coming back to get that again, right? And y'all probably can't see those wicks because the wicks don't be showing, but right. So this is the wick of the
Tim,
yeah.
I'm sorry. I was trying to get out to the field. So you would so to speak use what, like the 15-minute? I know you use that daily wick, but would it be appropriate, because today I was looking at that BISI on the hourly, which lined up with the 15-minute, I mean SIBI rather. Would you use the hourly, or you still would look at that daily and be like, okay, anticipating that wick? Because where I was anticipating it coming is right to that hourly BISI and the SIBI rather, I keep saying BISI, and dropping, because it lined up also with a 15-minute.
Okay, so if you're looking at
Which is what you showed. It showed, you see on the 30-second what it hit. That was an hourly.
oh, you talking about the same SIBI that I was looking at?
Yeah, but I was today.
Over here.
I was looking at the. I was saying I thought price would come there before pushing down up there to that hourly, which lines up with a 15-minute as well.
Okay, so this was the
It's
daily.
it's
This right here was the 7 a.m.
7 a.m. Yeah, and it's that 7 a.m. Well, I guess it doesn't count because it was a 6:45, but it still was like a 7 a.m. so to speak, SIBI.
So this SIBI right there, 7 a.m. SIBI right, the one I got highlighted on the lower time frame.
I have that. I have the 7 for the 15 minutes, and then the hourly one was the one.
Yeah,
also, yes, also made it 7. Well,
yeah, the 7 o'clock 15 minute. Yeah,
between the 6 and the 8. Yeah. So that's where I thought price would come, so to speak.
Yeah, and see that right there, that's just based off of structure, the intraday structure, not so much like it's what happened after the respect of the fair value gap on the higher time frame. See what I'm saying?
Right, but
like,
you saying you could have scalped it on that 30-second. If my anticipation was we were gonna go there before dropping, we could. That's on a 30-second scalping against the grain. Bam, right up there.
Yeah.
And then your real bias, like you said, was to come back down. Then we look for that setup as well, and that's your 2 trades, and you could get even a little more than your anticipated. Is that?
Yeah.
Am I looking at that wrong?
Yes.
Or?
Yeah. So like we looked over here, like if you took it here, if you took against the grain here at the inversion, I mean the reclaim, that could have got you like probably 80 points, right? If you took it over here, that would have got you like 50 something points. And then if you waited for this trade to set up here off of that first SIBI after the break-in structure, right? Then down to this sell side here, that's almost 150 points. And if you held it all the way down to the sell side that we pointed out over there at the gap, that's 200 points, all based off the 30-second.
Yeah. Okay.
Yeah.
All right.
So that's why I say you can trade it. You can, the higher time frame is going to give you your narrative, and then once you know what the higher time frame is doing, then you can choose, do I want to trade against the grain, meaning it's bearish but we're in a discount and I'm anticipating it coming back to a premium, and this is the premium array I will be looking to sell off of, right? So you can use the higher time frame knowledge to trade against the grain or wait and just trade with the grain. And so like with me personally, I trade against the grain all the time. Because like if I come in and we're in a premium and I'm bullish, well, I'm just going to look for a reason to short back to the discount PD array that I'm trying to buy off of, right? And that's why a lot of times, right, just like today, I shared something today. I don't think anybody saw it because when I first shared it, I didn't tag nobody, right? But I shared something today inside the screenshots, right? Because every trade ain't going to be a winner, right? I posted it. I said, I never want to make it seem like losses don't happen. After 2 losses in that account, I decided not to push it and switched accounts. Remember, a losing trade doesn't define who you or your strategy are, right? Don't define who you or your strategy are. That should say are. It's part of the game. Enjoy your day. Right, so after taking 2 losses, getting chopped out, right, I said, hey, I ain't pushing this account no more, right? And then so I switched accounts, and after I switched accounts, you know what I'm saying, I was batting 1,000, right? Don't think that I didn't say, man, I need to go back to this account and fix that. I did think that, but just like when I took that first loss, I was like, okay, I can fix this, I can get this back. Then I took that second loss. I say I ain't hitting. I ain't hitting in that account. I ain't hitting. I'm getting up out of there, right? And then after that, batting 1,000, right? 1 trade here, 2 trades there, right? Batting 1,000. But if it ain't no guarantee, if I'd have went back, I probably would have hit my daily loss limit in this account right here, right? So every day ain't gonna be no winner. I don't want nobody to think Tim always showing us these green days. Even on green days, I done took losses. It just so happened that I got it back. You know what I'm saying? I got it back. Some days you don't get it back. You feel me? Right? But I'm always trading against the grain, right? If I know, well, I ain't gonna say I know. If I got my analysis say we going down based off this PD array up here, if we're down here, I'm looking for reasons to trade up there, especially if it's a large range. Now, if it's just a little small, if it's just like a little 15-point range, little 20-point range, I'm gonna wait until it gets up there and trade with the grain, right? But if it's like 100, 200 points, 80, 90 points, man, I can grab 20, 30 points out of there. I'm gonna trade against the grain if it gives me the setup, right? It's all about, are you comfortable with going to the lower time frames? The lower time frames can yield a bunch of setups, but you have that, and that's why I said you always want to know what the daily is. When you said, do you start with a daily, or do you always want to start at the daily so that you understand what is the daily trying to do. And once you understand what the daily trying to do, now you can make your decisions. Okay, the daily trying to do this, so I know I'm trading against the grain, or the daily trying to do that, so I know I'm trading with the grain, right?
Okay, so today, since we had already kind of like pre-market and overnight, we moved pretty good range. You still look at it, right, to see if it's worth your while, or do you kind of say, "Oh, I'm gonna leave it alone," since we did a lot of?
Oh yeah, I'm still gonna look. Even if we did a lot, I'm still looking. I'm still, you know what I'm saying, because it's like you don't never know when Phil gonna let the tiger out the cage. You know what I'm saying? So I'm still gonna look. And even with Phil holding a tiger in the cage, there's still opportunity to make money. And no matter, like 15 minutes and down, there's always opportunity to make money, especially if you're looking at like sub 15-minute charts. If you're looking at 5-minute, 1 minute, 30-second, there's a plethora of chances to make and lose money, right? But you want to keep that higher time frame in mind when you're dropping down to those low time frames, because without understanding what the higher time frame is doing, you're just guessing. But once you understand, hey, this is what the higher time frame is doing, this is what the higher time frame is reaching for, and let's go over here, make sure, I want to see, this is the stuff that I had annotated, because, you know, people be thinking, it be people that be like saying little slick comments and stuff sometime about stuff. So we're just looking at these areas there, right? And now let me see if I still got my stuff on my charts over here, cause folk think I'll be get out of there, right? There we go. All right, so this is my 1 minute chart right there. All right, that's my 1 minute chart there. Pop that out, pop that over there, pop it over there. All right, so this right here, put that on 1 minute also. All right. Okay, so why can't I get all that in on the MNQ? So we see that this is that wick up there. All right, so let me see. Turn my daily wick on. I have my daily wick. Fiat Bissy, nope. Fiat Premium wick. Yep, there it is right there. All right. Change it back to a 1 minute. Okay. So there's our wick right up there. All right. So as y'all see, there's my hourly SIBI down there, my hourly SIBI down there, right? My SIBI right there, my SIBI right there, and then on the one I actually trade, there's a 5 minute SIBI right there, which would be right above that. If I come over here on that time frame there, that 5 minute SIBI right there, also got that one marked out. Let's mark out him right there, right there. All right. All right. Go back down to 1 minute there. All right. So y'all can see. All right. This is, I got a 15-minute BISI down here that's not marked out there, right? Y'all can see this is the actual stuff that little Timmy Rogers be looking at inside there, right? This is actual stuff I be watching, right? Actual stuff that I be watching here. All right, so then as you can see here, if I zoom in there, you can see how, right, I was watching this BISI right here, right there, to see if we respect consequent encroachment of that BISI right there. And then once we got back below it, right, looking to see if we defend the upper half. We're defending the upper half beautifully, watching consequent encroachment of the wick, because we're in between a tail of two cities right there, right? Once we got below it, right, beautifully, right? So all up and through all this right here is when I took those 2 losses and 3 wins. Remember I told you I had 2 losses and I had 3 wins, right? I took them 2 losses and 3 wins all up in this stuff over here. All right. But this is the MNQ, and we just walked through and marked all this out. And then if you look over here with the NQ, right? Exact same stuff that's marked out. Right? Exact same stuff that's marked. Only thing that's not marked out down here is this sell side liquidity right there. But there's the fair value gap, right? There's the 60-minute fair value gap. The 60-minute fair value gap. Right? Oh, that's a 15. I'm sorry. It says 15-minute fair value gap from 1 p.m. on the 23rd, right? And then if I come over here, right? This right here is from the 23rd. That's a 60-minute fair value gap from the 23rd. right? And if I go down to 15 minutes for that same time right there, right? This is the 15-minute fair value gap from that time right there, from the 23rd. That's the 15-minute for that same area, right? At 1 p.m. from the 23rd. That's the fair value gap that I marked out on this chart over here, right? Same thing that I already did. All right, man. We went into a whole lot of other stuff, but I think it was good stuff for us to go into, right? Good talks. We had some good talks. Do anybody got anything else before we go ahead and wrap it up? Because we've been on here for a while. Do anybody got anything else?
You can't tell us, so to speak, what to do, but you just showed very good example of just being fluid, getting in and out on 1 minute and below. Is that how you normally operate?
Yeah. Mm-hmm. Whenever I'm watching charts and trading, right, I got you can see what I got marked. I got like my 15-minute and my 60-minute stuff be like marked out, right? And I'm putting in like where they from, right? I'm putting in where they from, so I know where they from, right? And I know why I'm looking at them. I'm looking at it for a specific reason. Do I want to see it support price back into a premium, resist price back into a discount? I know that's what I'm looking at it. And so while I'm watching, let's come here, right? And I'm gonna like chop this off right here, right? So while I'm watching price here, right, price trades up, right, and as it comes back down, right, and I'm looking at this BISI right here, right? We got a BISI, we got a SIBI, we got another BISI over here that we're struggling with, right? This is the first BISI we created going up, and we're closing above consequent encroachment, but we're not taking off. So I'm like, okay, we're struggling with this. So since we're struggling with this, but we're not breaking down or taking off, now I'm paying attention to my discount PD arrays over here. So while I'm looking at my discount PD arrays over there, let's come here, all right, and we're gonna, I don't know if that's the right high from this time frame, but we're gonna see. No, that ain't it. This is it here. All right, that's the time. That's it right there, I think. Let me go up 15 minutes. That's not even it. That's it right there. Okay, that's my high right there. Okay, that's my price leg down, right? And so go back down to like the 1 minute, right? So I'm looking here, right? This right here is my 15-minute SIBI right there, and this is my 5-minute SIBI, right? So I'm saying, okay, once we come up here, right, this is like the last line of defense for keeping price down, right? That's my first SIBI on the drop down here from this 5-minute time frame. Okay, is my last line of defense for keeping price down, right? We've hit my last line of defense, right, and we've come back down, right, into this area here, right, and we bounced back up off of it. Okay, now I'm going in looking to see why are we not just melting down, right? So price comes, come here, right, come here, price comes down, okay, we get down here, right, and we're respecting this breaker right here, right? We're respecting this breaker right there. Price is closing, right? Respecting that breaker. All right, we're respecting that breaker. So then when we push back up, right, I said, okay, when we came up here the first time, right, we just cut through. We just like cutting straight through this 15-minute SIBI right here, right? We didn't come up here and stop. We just slapped through it and went into the 5 minute, right? So I peek at my 15-minute chart, right? I look at my 15-minute chart and I see when we came into there, right? We cut through, but we closed respecting it, right? So we pushed all the way up, right? Non-stop, but we closed respecting it, all right? So we closed respecting it, come back down, right, to my 1 minute, right? We closed respecting it, but while we was going, we did it as if we was driving to get into this, right? So now that we got into this, right, my last line of defense, right, we come back down, right, now, 15-minute, copy this over to that candle right there, right? So when we come back down here and we close, right? We close again, respecting consequent encroachment of the SIBI right there, right? So now see we hit my last line of defense, right? And we've respected consequent encroachment of the higher time frame last line of defense. Okay, so now when we did, it brought us back up. We're not falling back down, but we're still respecting the higher. So this breaker is keeping price up, right? But the higher time frame is still respecting the higher time frame on the higher time frame candles, right? So now I'm watching this BISI here to see how we act there. Are we cutting through it, right? So we come down, right? It's supporting price and it pushes us back up, right? It's supporting price and it pushes us back up into what we're already respecting, right? So I want to see us cut through this because the higher time frame is showing after two 15-minute candles that is still respecting this, right? So when we came into it this time, right, we pretty much wasn't using it, right? So we closed inside of it and we went to the 5 minute, right? Went to the 5 minute, right? We closed high in it, but then we immediately got back out of it, right? So we pretty much used that when we traded to it, got away, right? Had a little coloring outside the lines, but we hit it and we got away, right? So this 15-minute candle here, right? We come back up into, right, that first SIBI as we drop down, right? And then we close still respecting it, right? So now we open up a new 15-minute candle, right? When we open a new 15-minute candle, right, we trade down into the discount PD array, but now we're coming back into this 15-minute PD array. So now is this the time where we're going to use it and get out of there, right? So that's what's going through my mind right now, because we didn't use it as a reclaim here, right? Well, it's not even a reclaim, it's just a SIBI, right? We didn't use it as a SIBI there because we never traded through it. We didn't use it as a SIBI there, we just went through it, right? This 15-minute candle didn't use it as a SIBI because we was coming back down, right? So now we're opening up a new 15-minute candle, right? And this lower time frame stuff is doing its bullish job, but now it's pushing us back up into this higher time frame stuff. Is this the time where we're going to drop down, right? Why? Because we've attacked pre-market buy side, right? There's opening range buy side up there, so we may want to go touch that, but are we going to respect our higher time frame PD array this time? So allowing for this to do its job, right? But I want to see it fail, right? When we come down, if we come down to here, I'm allowing for it to do its job, but I want to see it fail. This is what's running through my mind right now at that time, right? While we're looking at that. And then, oh yeah, I mean, I forgot to go down into like the lower time frames to show like what I be watching on stuff, but I'll just do it from here. I'll do it from here. all this blue highlighted part. All right. So going into the 30-second time frame in this same area. All right. 30-second time frame in this same area. So while I'm watching, like, are we going to respect this? This is what the 30-second time frame looked like. Okay. So remember, this was the first 15 minute here where we respect consequent encroachment. This was the second 15 minute here where we respect consequent encroachment. And then when we opened up this 15 minute here, we dropped down, right? This wick is from the 1 minute. We're dropping down, taking out short-term sell side and trading into that busy in that inversion fair value gap right there on the 15 minute. I mean the 30-second. And then we trade back up and we come out and we're taking out buy side liquidity there, and we're trading up into an inversion fair value gap there on the 30-second time frame, right? As we're looking to see, because when we say we got a possibility of getting here, but what's in the way to stop that price can realistically trade to? That inversion fair value gap. That's the first busy that was created when we went up and made that high. So during this run up, price can realistically come into that, right? Price can realistically come into that. So if you know what I'm saying, I hadn't got like choppity chopped up already, right? Then I would be looking to short off of that, right? But since I'm waiting for more confirmation, I want to see it use that, right? And once I see it uses that, then I'm like, okay, this 15-minute candle here is using this as a SIBI. This one didn't use it as a SIBI because we just pushed through it without any thought of trying to show resistance. This one was already inside of it on the upper half, so it's trading into this. It's using this from a 5-minute time frame, but it's trading up into there. So this one is not using that as a SIBI. But when we come into this one, now that we've took care of that on the 5-minute time frame, right? Now that we've traded up to this right here on the 1-minute time frame, right? Now, right, the consequent encroachment is being heavily defended, right? It's being heavily defended, and we're trading back down through these bullish PD arrays, right, while respecting that. So now this is when we say, okay, now price is ready to go down. And this is the time where you can start looking at things like, okay, once we go past this, right, I want to see it resist price, right? Once we go past this, I want to see it resist price, right? So on the lower time frame, you can see once we get back below that consequent encroachment, right, now we got an inversion fair value gap here. This is the first one as we go up, right, that's defending price right there, right, on the 30-second. Yeah, it's overshooting it because this is a 30-second chart, but it's defending price, right? And then once we break down right past here, now we're below that consequent encroachment of that 1-minute wick, right? But now we're here inside of this mitigation block right here, right? We got a mitigation block right there that we're below, right? And we don't even try to trade back up into it, right? We just get that speed below that low right there, right? This is the time when you hear Mike saying, I want to see speed below that low. You get that speed below that low right there. And this is the low where you're looking for that speed below the internal liquidity. This is your logical draw right there, right? This is the time where you will be, you know what I'm saying, pulling out event horizon right there, right? Right up in the air. We pause there at event horizon, drop back down, use it, drop back down, use it, drop back down. You see what I'm saying? Like that. But that's the stuff that be running through my mind when I'm watching the charts, and like the different way I look at it with the different time frames. Anybody else got anything? That's it. Hopefully y'all got something out of this, man. Hopefully y'all got something out of it. Thank y'all for y'all give it up for yourself, man. Y'all look so beautiful out there, if I do say so myself. Tomorrow is Wednesday. Tomorrow's Wednesday. That means we got pre-market analysis. But you know what I forgot to do today? I forgot to do the public pre-market analysis today. Y'all didn't remind me, gang. Ain't nobody pull up and say, hey, Tim, you didn't do the public pre-market analysis. Should I do it tomorrow or Thursday? Tomorrow is tape reading with the gang. Tomorrow is tape reading with the gang. Thursday is the last day of the month. What's on the economic calendar for tomorrow? Tomorrow we got FOMC announcement. So the morning might be trash. We got FOMC announcements tomorrow. So the morning might be trash. So I'll do the pre-market analysis. I'll do the public pre-market analysis tomorrow, and then once we do the pre-market analysis, we'll just switch off. We'll end that stream and switch over to a private tape reading stream with the gang. Since I forgot to do it today, I jalapies to everybody. But anyway, appreciate y'all for pulling up, man. Again, this has been another episode of the Intraday NQ price action recap. yeah, man. All right. Hey, man. Till the next time I decide to get on Algo's internet and share my thoughts on this thing that we call price action. It's your boy, Timothy Lee Rogers Sr., a.k.a. Aranya Grande. That should mean Big Spot if you don't hablo español. Y'all be safe out here in these trading streets, man. Gone.